All right. Well, hi, my name's Tyson Halsey. I'm a managing member for Income Growth Advisors. I'm also the president of Optima Process Systems, which is a energy startup. So I look at the public markets and the private markets, and I've been a client of Marty's and raised money through him, meeting some very interesting and talented people. Uh, and anyway, so here's my quick overview. I think that actually in the last 5 years, I've actually had a good record. And one of the models that I like the most, let's see here, just trying to figure out how to get this to work. Okay, it's the risk premium model. It's the Fed risk premium model. And what I think is really particularly important when looking at investing is where
Hey,
do it,
Tyson, do you want to turn it into a slideshow?
excuse me?
Do you
Yeah,
want to
isn't
turn it
it
into
not
a
a
slideshow?
slideshow? I'm
Just start
sorry.
it,
Oh, wait, let's see here.
go to slideshow, start
Uh-huh.
it from beginning.
Oh, wow. Look at that. So, technology, I love it. Again, I'm still Tyson Halsey. And what I was talking about is the Fed model that measures risk premium. And I think that a lot of times analysts, Wall Street, are inclined to say this stock is very cheap. Well, cheap is a relative thing, and particularly when looking at the S&P 500, it should be compared relative to probably real estate and in particular bonds. And what basically the risk premium measures is the earnings yield of the S&P versus uh, the 10-year U.S. Treasury. So right now, the 10-year U.S. Treasury yields, I don't know, 4.3, and the earnings yield on the S&P 500 is probably about 4.35, 36. And so basically, you're not getting paid much to be in stocks. And what I just want to show is the history going back to the 2000 peak. The risk premium at that point was -2. And that told you that was a terrible time to be in the market. You probably should be shorted. If, on the other hand, you bought it when it was at 6 at the bottom of 2008, 2009, or during the Euro crisis in 2013, and again in March of 2020, those were great buy points. Where we are today, the risk premium is getting into dangerous territory. There arguably is no reason to be in the S&P 500 when you can be in 10-year treasuries, which effectively yield you the same amount. Another thought that I have that I think is important when looking at this is cycles. And I think that there are inflationary and deflationary cycles. And we have just come through a deflationary cycle that began in 2009 until now. The S&P has killed it, and inflationary assets, commodities, oil, gold, have not done well. And but however, from the peak in 2000 to 2009, if you were in oil or gold, you were up tenfold. Similar situation in the 1970s. If you were in oil and gold, you did great. And then you got into the deflationary period. This is when Paul Volcker took control of the Fed, interest rates started declining, and you had nearly 20 years straight up. We are heading into an inflationary cycle, and I think that that's one of the big risk factors to be looking at. But the argument is not only is the market broadening, it's broadening into other asset classes and commodities. In my opinion, this feels very much like 2000. Not exactly. We've gotten a double top here, but basically, you are having parabolic moves in the major large cap tech. And typically, when stocks go up at an accelerating rate, that is, it's not sustainable. And I think that we're at a point where if you've been in the Mag 7, you've done incredibly well over the last 2 years, but I would be taking money off the table and allocating away from that. And one area that I like is gold. And gold did incredibly well in the 70s. It did well from 2000 to 2011, and now it's moving, and I think it will continue to do well. What I'm doing with clients now is building portfolios using closed-end funds with high yields. These are some of the names that I like, but you're getting 12% yield Master limited partnerships, which I've been investing in for 20 years, yield around 7.3, but really the dividends on those, the yields, the taxable equivalent, since it's largely a return of capital, call it 90%, is close to 11%. So when you're looking at what I think is a market that has risks, and I'm sorry here, and you can own high yield bond funds, you can own MLPs, you can own closed end funds and equities. I mean, look at this India fund, 11% yield, and India is now the most populous country. I think looking away from the S&P 500, the triple Qs, these market cap weighted indices is the way to go. And there's one other thing that I want to mention. Again, the risk premium right now is very close to zero. This number has actually moved up recently, and it's simply because interest rates have declined. But that's basically my thoughts. Are there any questions?
Keep on going.
I have a question.
Yeah, of course.
I don't know if everyone can hear me. And Tyson, I agree with a lot of things that you said, but in looking at the chart you just threw up with the different higher yielding things that you're recommending to clients, you know, given the fact that despite the Fed has lowered rates, it really hasn't affected rates, right? The 10 years up. So why would I be investing in somebody that's yielding 13 and taxable versus just buying the 10-year?
Did you hear that, Tyson? Why invest in
Yeah, I
something
did,
that's
and I'm
yielding
thinking
13
about
and
the answer
taxable?
before I speak. Sometimes I try to do. In a retirement plan, I would say that I would definitely want to own these for certain. You do need to look at it from an after-tax standpoint, and it really comes down to individual closed-end funds. And I think the word's idiosyncratic. I'm not saying universally I want to be in these, but I think selectively I'm looking for places to invest that are not going to be correlated to the S&P. And I don't think that bonds particularly make sense. And I think that the yield to get a 4.3, a low 4 return, that's not highly compelling to me. So it depends on the closed end fund, but I'm not sure whether that answers your question.
We have another question, Tyson.
Go ahead, fire away.
Tyson, can you address how the drop in oil prices under Trump, because he's planning to drill a significant amount to lower oil prices, and obviously the cost of living will come down based on that. What investment opportunities do you see, and how is that going to affect the market? Inflation, non-inflation, et cetera.
I love that question
Anticipated
because
oil
it's a
drop.
great question. I know a lot about it, having invested in MLPs for about 20 years. And I think the important thing is to look at upstream versus downstream. Upstream would be E&Ps. And if you're a E&P and the price of your commodity, natural gas or oil, is going down, you're not going to make as much money. So you don't want to be there. But midstreams, which are the pipelines that will get a toll, their toll road business models, they will see more volume. And so being in MLPs makes a great deal of sense because volume should increase as we are producing more natural gas and oil, and that would be where I would focus. But just try to recognize which has the commodity exposure and doesn't. And many MLPs, most MLPs that are pipeline MLPs, are safe. There is one warning, I would say. There has been a belief that MLPs are not correlated to interest to oil prices. And in 2020, oil went way down, MLPs went way down. All the closed-end funds actually had liquidations, margin calls, and the whole sector just was utterly crushed. That was a great time to be buying MLPs, but MLPs are attractive, but they're not a screaming buy. 4 years ago, in March of 2020, and for the next several months, when actually oil was negative, that was a much more attractive opportunity. More questions?
Hey, Tyson, what do you think about this whole Trump and crypto, like he appointed David
I
Sachs.
think that there is a
Crypto czar?
tremendous opportunity in crypto, but I could be completely wrong. I've only recently have I been looking at it, studying it, watching video clips of Michael Saylor and MicroStrategies. But the argument that crypto could become a treasury type asset for corporations is compelling. If, however, that becomes a treasury asset for countries, then crypto, Bitcoin could be massive, absolutely massive, because compared to the size of gold in totality, when you think about central bank balance sheets, it probably has 100x upside to be equal. And I'm sorry I don't have the exact slide from. I would certainly suggest anybody interested go and watch the MicroStrategies earnings call from the last quarter, but they show the size of Bitcoin relative to gold, and it is a speck. So if in fact, and I believe I heard yesterday on the news, there is legislation currently proposed to put Bitcoin on the US Treasury balance sheet. The US Treasury already owns Bitcoin through seizures of Bitcoin, and the upcoming Treasury Secretary apparently is a fan of Besant is a fan of Bitcoin. So I think that there is a play there. It's not an area that I specialize in, but I think that in the same way that gold makes sense, and I saw yesterday China was buying more gold, but I wouldn't be surprised that you continue to see countries want to compete more and more with the dollar, and they want to support their treasury balance sheets with owning other assets than US treasuries.
So you're saying crypto reserve may happen?
Yes, absolutely.
Okay, we have another question.
I see the crypto and I correlate crypto to, say, hypothetically, the US dollar. The US dollar is fundamentally backed by the tax power of this country, etc. Weaker currencies reflect the inability to tax or the economies of those countries. Correlate that to crypto. Where is the foundation for crypto? It's a more speculative item that doesn't have the full faith and credit of anything behind it, like the US dollar.
So you're asking me to think about or comment on perceptions. And I don't know where things are going to go, but certainly the idea that if Bitcoin, cryptocurrencies are determined to be credible assets and can be held on balance sheets of corporations or central banks, then I think that there's great upside. With regard to the dollar, I think that you're correct that, and I think that the Trump administration wants to preserve a strong dollar. And Scott Bessent, after his years working with Soros, is very, and I think probably the reason he is the Treasury nominee is because he is very sophisticated in understanding these issues. But I can't predict where the dollar is going to go and where things are going to go going forward, and particularly, Bitcoin. But I do think that and I haven't done it yet. I think that starting to add, maybe 1% or a fraction of a percent to something like Bitcoin can be justified. And heretofore, I've always been of the opinion, if I don't understand it, I don't want to own it.
Yeah, there's a tech question in the Q&A. That Google has announced it has a quantum chip, and quantum is supposed to threaten Bitcoin. So, but I'm not sure anybody here is qualified to answer that question. So,
Right. Anash might be able to answer it. Yeah, come on.
no, he can talk. Why don't we talk about it during the next panel?
Sorry.
What you're a tech guy, Minash?
Yeah, pretty so.
Oh God, I feel sorry for you.
He's the smartest guy in the room.
Congratulations, you win the award.
He's traded 300 million shares of stock in a day with his quant operations.
Nice. Well, we're gonna get to that in 10 minutes. So Tyson, do you want to finish your deck?
No, that was my old deck. That was actually
Can
the
you go
deck,
back to that one
that was
slide?
supposed to be my 3 slides for the next
Tyson,
section.
can you go back to that one slide that you had? That talked about, I think it was like a high yield slide. You had like Aberdeen right there, Aberdeen Healthcare Investors. Is that
Yes.
is that a global fund?
Yes.
Right, because I thought healthcare was just crashing in the USA right now,
And it is.
but it's doing well
And here's
globally.
the thing about these things. These are not liquid, and you really have to do the research on each of these. I mean, you're not talking, billions of dollars in liquidity, but they do have portfolios, and these portfolios can trade at premiums and discounts to net asset value. And sometimes due to people selling for tax loss purposes or whatever, they just go down and people just sell them. But I mean, I think that you look at getting a yield of 11%. I mean, if we're gonna, I think that there have been a couple articles, research pieces put out, Goldman, Bank of America, and Schiller has done this kind of work saying, when you start with a high valuation multiple in the S&P 500 where we are now, we should only reasonably expect to get about a 3% return for the next 10 or 20 years. And I think we're in that kind of environment. And I think the question is, if you continue to stick to a 60-40 in a retirement account, that's probably the wrong move. And I think that if I can get 11% owning a diversified group of assets that have a high yield and fundamentally are attractive, I think that's a smart diversification move.
Were you the one who said that you were looking at India more closely?
Well, India is at the top of the list here in terms of a closed-end fund, and its yields unbelievably attractive. I'm not sure whether there's a problem there, but what I would say is we now know that India is the most populous country in the world, and John Templeton taught us that you want to follow population growth, and they're going to have massive demand. And I think that if you can be in something that should see growth over the next several decades and offers you an attractive yield, that's probably a thoughtful place to be putting your money.
I think India is the only G20 country that has positive population growth. My question about India is the structural issues, but maybe they're overcoming those structural issues with the government.
I believe
thoughts on that?
capitalism has its way, and I think that the real issue is we loved China for the last several decades, and now we're not as happy with them, and they are one of the most logical beneficiaries. They've got to do a lot to clean up their political system and operate better, but I think I think that India is gaining against China, where China is losing business to India, and I think that trend will continue.
Yeah, it's interesting. I don't think India has the kind of command and control economy that China has, but we're going to find out, I guess. So, well, listen, Tyson, great job, and you're going to stick around for the next panel too. So, thanks so much.
That's correct.
You're gonna come here,
Yep.
and I have Manoj and Suzanne Murphy.
And Jeffrey Hirsch, he's online.
Is he online? I'll track him down.
Okay, thanks.
So why don't you come on up, and we're gonna adjust the camera so it has a full view of you guys. So.
Where's Peter? Oh, there he is. Beautiful. This is beautiful. Yeah, it's great. Well, thank you. Marty built it just for IvyFON, so this is really good. You must have a heck of a legal bill here. So these are the new facilities conference rooms here at Polson Ellie, one of the leading law firms in town. And we are very grateful for them for hosting us this morning. I'm sure Marty's already done that, but I missed it, so I'm doing it now. So thank you, Peter.
Very kind of you.
Tyson, great job. Not hearing anything, turn volume up. I think that's a note for you, Marty.
I can hear you.
So this morning, we're going to be talking about alpha strategies. And how do you find alpha in the current market? Where's it going to be? Where's it not going to be? Things along those lines. And help me along in this conversation. You just heard Tyson a minute ago, but he is going to be speaking. We have Suzanne Murphy to my left. Manoj Narang, who's CEO of Mana Partners. And I'm sorry, Suzanne is the managing director of Lamp Company. We'll get to it later, I'm sure. We're going to be talking about a bunch of topics related to alpha strategy. Alpha strategy means you outperform through managing, typically as opposed to being passive, although there are some passive strategies, and maybe with AI, we'll see more passive strategies generate alpha, we'll see. We try to identify market inefficiencies that allow for alpha, and they're usually not long-lived, right? Once you get it, you're achieving it. Competitors come in, market changes, dynamics, all that stuff. So it's always in flux, always changing. So my name is Mark Heil. I've been involved with alternatives since the mid-90s in marketing, capital raising, fund administration, and helping investors tap into retirement funds to make investments in this space. I'm currently a managing director of Pickwick Capital Partners. We're a FINRA registered advisor to middle market companies and alternative asset funds. We do, pretty typical M&A work, advisory work, things along those lines. We're finding a bunch of alpha and a bunch of different strategies. There's in every, if you look at real estate, there are certain sectors, right, in real estate that are performing well. If you look in venture, you'll find some strategies that are doing well. So we're going to discuss all those this afternoon or this morning as well. But quickly, let's just remind everybody, this is a panel discussion for educational purposes, not to be considered tax, legal, or financial advice. There you go, Howard, you're saved. You don't have to repeat it. To the extent that one of us offers an opinion, our opinion alone may not be reflected by our firms. For the next hour or so, we're going to have a great conversation. I invite you to be part of it. And I hope you throw out some good questions. Ross is already threatening. I can see it. So Ross, we'll look forward to whatever you toss our way. Good to see you. Be part of the conversation, but we'd ask you to be respectful. Don't make speeches. Just get to the point of your question, all right? With that, I'm going to ask my panelists to introduce themselves. And Suzanne, you're the closest one to me, so you can lead off.
There you go. Thank you, Mark. And as Mark said, I'm a managing director at Lampe Conway, which is a fund based in New York. We focus on the lower middle market space, both stressed equity and credit. I would call it event-driven special situations. We've been in business for 25 years. The last 10 years, we've spent our time as a family office, and we're actually looking to raise a fund to do exactly what we did before with the same team. The other hat I wear is I was a partner of a hedge fund that we sold to the Carlyle Group in 2010, created a liquidity event for me. I created my own family office. And so sadly for my accountant, I get my own 40K once a year. So we look at a lot of different things. I would say the investing in the family office is primarily through funds and primarily through alternative funds. So I would say to people, it's easier to say what we don't do. We don't tend to do long only equity, and we don't tend to do traditional fixed income. Never say never, but we sort of then will look at, thank you, at everything in between. But we've always felt that the alternative space was a better place to be than long only land. So that's a little bit about me.
Manoj, you're here in person, and you've already been identified as the smartest man in the room. So my apologies if that embarrassed you in any way, but I feel it's probably very true too. So tell us your background.
It's probably not, but nevertheless, my name is Manoj. My background is in quantitative investing. My academic training is math and computer science. graduated from MIT in 1991 in those subjects. And during the 90s, worked at many of the major Wall Street firms, most recently in the late 90s at Goldman Sachs on their fixed income arbitrage desk. And since 1999, I've been an entrepreneur in the quantitative finance space. So my firm, Mana Partners, is a quantitative asset manager slash fintech company. We operate a few different lines of business, but they're mostly predicated upon the ability for our technology to ingest massive amounts of financial information, whether it's unstructured or structured information, such as news, such as real-time Edgar filings, company earnings announcements, et cetera. And then we nearly instantly, our models translate all of that stuff into a term structure of forecasts for the 2,000 most liquid stocks in the US and also around 500 ETFs. And by term structure forecasts, I mean all the way from 1 second to 1 year and everything in between. So based on that term structure forecasts, we operate a variety of different strategies, most of which are market neutral. So in terms of our view of alpha, what we think of as alpha is excess return above and beyond what quantitative risk factors are able to generate. That said, we also recently launched a quant macro program where rather than neutralizing a stat-R portfolio, let's say, to dozens of risk factors, we actively position in those risk factors to generate returns. So anyway, we manage currently around 400 million of AUM, which is rapidly growing. And we also sell our signals as a research product to some of the top quantitative hedge funds in the world. And we also have a fintech practice. So for example, Bank of America is a client of our big data analytics platform. I could go on, but I won't.
I think you hit the points there. You want to
I just have a quick question on the funds that are market neutral. Are they highly levered?
4x.
Yeah, so that makes around 1.5, 1.6, right?
In terms of gross market value, yes.
Yeah. Yep. So I want to move on. Jeffrey, I would like to have you introduce yourself and talk about your background.
Thank you. Hey, I'm probably one of the good to be here. Appreciate the invite, Marty, and honored to be on this panel. I'm probably one of the only guys here who's not running money, but we've been doing something called the Stock Traders Almanac for 58 years. That's the 2025 edition that's out now. Basically, one of the most influential books on Wall Street. It's been on the desks of top money managers, advisors, and traders and brokers for 7 decades. It's something my illustrious father Yalehurst started back in the 60s, about the same time as I was born. So I'm as old as the almanac. I grew up working on it and shipping it out to everybody. It is basically a calendar of all of the market's indicators, strategies, and schedule. It was something my father put together after working at Indicator Digest for many years to sort of put the market's schedule in calendar order so that he could keep track of the market schedule along with his own. We wouldn't be doing it for 58 years if it didn't click with people. Over 1.5 million copies sold. So I'm the editor-in-chief of the Stock Traders Almanac. We also have a newsletter service where we have, about 50% of our subscribers are advisors. They use it with their clients. There's fund managers that use it to keep track of what's going on with the market. I know people talk about seasonality and cycles a lot. We basically put the 4 years presidential election cycle on Wall Street's map. My father created the Santa Claus rally and the January barometer, also the best 6 months switching strategy. He coined the term Octoberphobia. And you've heard a phrase that if Santa Claus should fail to call, bears may come to Broad Wall. That's him. He was also a songwriter. People talk about Sell in May and Go Away. I'm not as good of a lyricist as he was, but in my response to Sell in May and Go Away, I say you got to buy in October and get your portfolio sober. So The newsletter service has stock portfolios, small, mid, large cap, ETF switching strategies, market timing. I'm pretty bullish for 25. Not as bullish as I was for 23 though. So I think that covers it. You can find us at stocktradersalmanac.com or wherever books are sold.
Sounds great, Jeffrey. I'm hoping you're posting those lyrics to the chat. I'm sure people would appreciate it. While you're at it, tossing your contact information, people know how to reach you.
Sure.
Tyson, we didn't forget about you. I want to come back. Just a quick intro. I know you've already spoken, but for people who maybe have just entered into the room or people that are online that have just joined, let them know who you are.
Tyson Halsey. I'm the managing member of Income Growth Advisors, RIA here in Charleston, South Carolina. I also have a energy startup company called Optima Process Systems, which has made me something of an expert in the energy space in aggregate. And I already gave a presentation, but I would say that I am concerned about the equity markets. We're in a unique period, and at some point, I'd love to have Manoj's comments on this. We were talking about it yesterday, as well as Jeff Hirsch's. We're overvalued, but you can stay overvalued. And Manoj had spoken about, I think, winner-take-all phenomenon, which was a new one as it relates to some of these giant companies and why we can continue to see the Magnificent Seven do well. But that would maybe at a different point, or maybe now, I'd certainly be interested in hearing the thoughts as to what are the risks going forward, because it seems like we're in the upper ends of valuation metrics historically, but this we may remain overvalued for a long time. And how much longer is that? Maybe Jeff can answer that, and then Manoj can talk about what he was talking about in terms of.
Before they do, I
Well,
want
and
to
I
just type in just real quick here. And
If you want to be moderator, that's fine.
I'm ready.
One of the things that's very interesting that I don't think we're really focused on is this year we have, for 2025, we're going to have to refinance $7 trillion in debt. So what we've been doing for the last few years has been taking short-term debt and paying off long-term debt. And now we have to replace the long-term debt that's coming due. And it's about $7 trillion that's going to be due this year, which is much higher than we've ever had to do before. And we talk about risk faces. I think that's one of the big ones. So Manoj or Suzanne, do you want to chime in?
I mean, I think you've said all there really is to say, right? It's a big risk hanging out there. We're obviously going to have to refinance it. I do think foreign governments, which have been large buyers of treasury assets, are going to want more of a risk premium than they have before. So that could put pressure on rates when these pieces of paper do get refinanced. But I don't know that I have any special insight about it. I do want to comment on something that Tyson said about the Magnificent Seven and what's been driving the market. And somebody made a really interesting point to me the other day about a lot of the companies that are driving the market, that are the darlings today, are still often run by their founders. And those founders are still young and hungry and focused. And the same person made the comment about Microsoft, right? Scott Ballmer had gotten the culture had become older and stodgier and whatever. And when he left, there was real new invigoration in the company. But the point was that the Metas of the world and the NVIDIAs, they're still run by I hate to say it, kids that founded them, and they're still there. And that could keep them at the forefront for a lot longer than one might think.
Manoj, you want to share your thoughts?
Yeah, sure. So in terms of the trillions of dollars that we have to refinance on an ongoing basis and rising annually.
And risk to the market.
Yeah. In terms of that, I think, it's always been the case that there's a record amount of debt that we have to refinance because it's, steadily increasing over time. At the risk of stating the obvious, we need to normalize that by GDP and, Also, the level of interest rates bears heavily on our ability to refinance effectively. And that brings me to what I think is one of the biggest risks, which is that for my entire professional career, which I'm pretty old at this point, we've been in a secular bull market in treasuries until recently. And, that's been instrumental in the US government's and other foreign governments' ability to, issue more and more debt. And one of the big drivers of that was globalization, global trade deals, technology, et cetera. And so with the rise of nationalist movements around the world and the unwinding of trade deals and the rise of protectionism, I worry that we may not be headed back to the low single-digit interest rate paradigm that we've grown accustomed to over the past several decades. And that could really throw a monkey wrench into the ability of governments to finance their debt and issue more debt. In particular, because a lot of the most productive countries in the world in recent decades are in population decline now. And so their needs to finance, their public works and their public services is only going to increase as their populations age. And so the debt burden is bound to grow in those countries and not necessarily the ability to finance that debt. So I think that's a huge and understated risk factor. But I was also asked about the so-called winner-take-all phenomenon. So winner-take-all basically refers to just natural state of affairs in unregulated capitalist systems where, particularly when, like if you look at the US economy, not to say that it's not regulated, but the fact that money supply is continuously increasing, the fact that population is continuously increasing, that creates a lot of fuel for the fire of winner-take-all. Meaning, so what winner-take-all refers to is that companies that have early mover advantage, not necessarily first mover, but early mover advantage, and are able to build user bases that have network effects that then, strengthen their products and have built up immense cash reserves over time. They have basically insurmountable advantages and just are poised to continue to grow and grow and grow. And we've seen that with the so-called Magnificent Seven. The name of these companies keeps changing over time. First it was FANG, then it was FANG plus whatever the hell, and now it's Magnificent Seven. But the point is, it's a small, rarefied club of companies that keeps growing exponentially relative to the rest of the world. Like, because we have, because the financial press is dominated by cap-weighted indexes, it's very easy to be under the illusion that, EE ratios and stock prices are just going up and up and up. But really, that's true just for a small, concentrated group of companies that happen to be the beneficiaries of these winner-take-all effects. So that's all well and good in terms of investors in these cap-weighted indexes until concentration risk comes to bite you in the behind, so to speak. And what might be the catalyst for doing that? Well, a lot of these companies are so profitable that they can afford to spend virtually limitless amounts of money on pet projects that have yet to pay off. Artificial intelligence being one of them, and quantum computing being another. And the jury is still out on whether these things ever will pay off. They certainly have not so far. And so if the economy goes into a recession and threatens the core business models of these companies, these massive expenditures that they've laid out could become a double-edged sword for those firms and bring them crashing back down to reality. And I think that's a huge underappreciated risk factor.
I totally agree with you. And I think the flip side of that, because we're talking about alpha and where to generate
like-
alpha,
Don't worry, where he's gonna take it. So
Is-
thank you.
smaller companies, right, have become the have-nots, and they're gonna need capital in different ways, and they still have good products and they can be bought by the larger companies. But one of the reasons that we're excited about relaunching a fund in the space that we operate is a lot of these smaller companies are being totally overlooked. And that we think that there's going to be a lot of alpha to be generated there, because again, nobody's paying attention to them. What I would also say is something that I really worry about in this market is the risk of AI. And while I think AI is ultimately going to be huge, and either in my lifetime or my child's lifetime, obviously one of the greatest innovations we've ever seen, as we saw in 2000 when the fiber companies all went bankrupt, right? We put all this money into putting fiber in the ground, which ultimately we knew we would need, and now it's all lit. But a lot of companies went bankrupt in the meantime. Same thing happened with the NASDAQ bubble. I wouldn't be surprised to see something like that happen in the AI space before it becomes really exciting.
Did you say anything about alpha? Where did
did.
you see the alpha there?
Well, what I was saying is I think there's going to be a lot of alpha in the smaller cap companies.
Perfect.
If you pick them properly
Right.
versus some of the larger companies, which are going to be much more correlated to the market.
Gotcha. And those will also be swallowed up to a certain degree by those magnificent seven as they have been.
I want to make one comment on what Manoj said, which is that, we have these Magnificent Seven, which are these real tentpole companies that can acquire anybody, right? I mean, I guess Europe has had some negative legislation against those Magnificent Seven, and the Justice Department recommended a breakup of Google selling Chrome, et cetera. But until that's changed, those companies will continue to be the buyers of, and so for people like us who are making private investments, it's a negative because companies that should be IPOing are being purchased, are being bought out instead.
And sometimes just because the big ones want to put them out of business. It's easier to buy them and shut them down than have to think about the competition.
There was actually a great company which I used to buy alcohol for all of my sponsors last year, and they were purchased and put out of business. They were shut down.
Yeah, I'd like to ask you a question, though. If Trump's policies take effect, there's going to be a tremendous amount of growth that occurs in this country. That growth is going to occur at the expense potentially of other countries because manufacturers are going to come here, taken away from there, so to speak. How would that impact our financial situation, meaning our debt situation and the funding of it? And what is the macroeconomic effect to other parts of the world because manufacturing is coming here and not going there? So you're taking away from them to come here.
Well, I think it's impossible to know the answer. And the reason is because, the onshoring of manufacturing is not a monolithic proposition. The previous speaker alluded to the fact that some other developing countries could be beneficiaries of, the recent, change in outlook towards China and, other countries that are friendlier to the West might be beneficiaries of that, India among them, but also other places. And, but in terms of onshoring manufacturing, that would be inflationary in the near term for sure. But then a countervailing force against that is, of course, increased automation. I mean, nothing can compete with automation in terms of being a deflationary force, right? So we've heard Elon Musk talk a lot about how in the future, robots might be a bigger revenue generator for Tesla than their current core product. I mean, he says that about a lot of things, but robotic automation is one of those things. And he has the perfect place to battle test those technologies in terms of his own factories. And it's not far-fetched to think that this is one of the lowest hanging fruit sort of applications for artificial intelligence. Is basically robotic automation of manufacturing processes, because unlike self-driving, where machines have to interact with human beings who are unpredictable and irrational sometimes, manufacturing processes are a lot more, closed system type setups. And we've seen artificial intelligence do really, really well in closed systems like chess, for example, being the canonical example, where chess is being played at a 3,800 level compared to 2,800 for the maximum human players. So anyway, I think that in the near term, it would be inflationary for sure, modulo the fact that, repatriation of manufacturing is going to take decades. And in the really short term, if, to the extent that supply chains have to be rearranged, other low cost of labor countries are likely to pick up the slack. So there's a lot of moving parts, and I think that makes it very difficult to see how Trump's policies or any other policies would
I want to follow up
would
his
change things.
points there, especially on supply chain. If we got in a war with China today over Taiwan, how many people think the US would win? Show of hands. How many people think it would be a long
Why
war?
would we get into a war?
Oh, just play it out here.
Can you
How many
define when?
people think it would be a long war? So we're thinking it's all going to be
I
a
don't
short
think
war?
China wants to get engaged. I think it's all, just trying to get resources around the world.
Well, here's something to consider. Again, it goes back to supply chain. If we got in a war with China, we'd be out of bullets in 6 months. We wouldn't have any munitions because they control all the chemicals and things that go into those.
My feeling is that we would lose by any conventional definition of winning or losing. And the reason is simply that since the advent of the Cold War, there's almost no precedent for the superpowers to confront each other directly. And inevitably, the way we would help defend Taiwan is through arming Taiwan. And that's just not going to work. I mean, look how well that worked in Ukraine.
It was more hypothetical, just showing the risk to the country that we're at right now, depending on others. So I do think a certain amount of onshoring is needed, and we need to rethink our supply chain.
It's already been proven because Russia can outproduce us, the whole West, right? But I have a macro question for Josh.
Okay, well, I want to get our other panelists who are online here involved in this discussion, and they've been very calm and waiting, sitting there. So I do apologize to them. And I want to throw it out to them, and I'm going to have them go. Oftentimes when consultants talk to endowments or pension funds, they have their heat maps, right? And they have red is, the areas they're hot on, and blue is the areas they're cold on, right? So I'd like, Tyson and Jeffrey to comment about what they're seeing red right now and what they're seeing blue.
Tyson, you want to go first, or should I take a crack at it?
Go ahead, Jeff.
I mean, we're seasonal, foundation. We look for trends that, are in line seasonally. Right now, small caps are about ready to hit their January effect, early January effect. We show in the almanac how mid-December is when the January effect really takes off, when small caps start to outperform large caps. So we're looking for the Russell to hit a new high, and small caps are looking attractive. We've just put out a couple of seasonal trades on copper and energy, not oil and gas per se, but the XLE, the big energy companies, and the servicing firms. So there's a couple of areas there that we like. I mean, I'm pretty bullish on tech for the future for next year. There was you guys mentioned inflation before, and I just want to point out, historically, countries inflate themselves out of debt. I mean, you mentioned debt before. Historically, countries inflate themselves out of debt. And I do think it's a risk. I mean, it's one of the government debt is one of my headwinds on my, webinar for my subscribers. And I think that it's one of the major motivations for the Fed to cut rates, to continue to cut rates. So, I'm hot on small caps. I'm hot on energy, biotech, copper, a couple of areas right now. I think Bitcoin's got some upside left as well. I know that's a little bit wild and Wild West for this crowd, perhaps, but those are some of the areas that we're looking at. So I don't know, Tyson, what's on your radar?
I just, before you go on, I have a quick question about small caps, because I saw Lisa Shallett, who's the CIO of Morgan Stanley, speak recently, and she said normally in a decreasing rate environment, she would be recommending, allocating to small caps or being more involved, and she's not, because the cohort of public stocks is kind of the bottom of the barrel. All the good ones are private. So I just wonder if you have a thought on that.
I'm not seeing that. I mean, I don't, know what she's looking at, but I mean, the Russell has not made a new high in over 3 years. It's been since November 8th, 21. It's threatened a bunch of times since the election, maybe 3 times the charm, as I posted the other day. It's tracking the seasonal pattern that I have right here, which is the Russell 2000 versus the 1000. I think there's some issues with small caps. I mean, rates coming down are going to be beneficial to them. You definitely have to be a stock picker, and as you mentioned, before, it's about individual stocks. But there's a nice trade. I mean, I could throw up a chart, or you could see it on my recent blog post of that mid-December point where small caps start to take off. It runs into January and then early March, and after that, I think is probably when we'll get a little soft patch in Q1, when some of the either disappointments with the Trump administration's not being able to come through on their promises, or some of the difficult, less savory policies they're putting through that are going to hurt a little bit in the beginning. So I think that runs along with a little first quarter weakness, maybe first 100 days type of thing. But small cap seasonal trade is set up pretty well right now.
All right, Tyson, give us your EMAPs. What do you see red? What do you see blue?
So I would say the two risks that I see are, one, peace is going to break out all over the world because Donald Trump knows how to manage things. And secondly, that interest rates are definitely going lower. I like to think that we will see peace, but it could easily muck up. I'm looking at what's happening in Syria. I'm not sure how easy it will be to settle this issue in Ukraine. Anyway, and also lower interest rates. I would love to think that would happen, but it's easier said than done. I think we're all very excited about the prospects of Elon Musk cutting $2 trillion out of our deficit. That would be great. But in terms of areas that I think look attractive to me, I think China looks very attractive. And I think that while I've mentioned gold, I think gold miners are very attractive because they have not moved, although gold has. And so, like, I own one particular miner, and the stock has gone down for 3 years while the price of gold has gone up. And frankly, they found more discoveries. So I just think valuations there will ultimately do very nicely. I think that small cap, I think value, I think other emerging markets are places where, as money starts to migrate away from these Magnificent Seven, the S&P 500 and the NASDAQ 100 are places where I think you want to be.
Fantastic. Suzanne.
And Jeff, you're speaking, but we can't hear you because you're on mute.
Thank you, sir. That's because I muted for you.
Thank you.
We
I'll
just
mute
got
myself.
stopped out of our GLD and GDX positions. The seasonality trade that we had ends around December. Used to be the old fourth quarter gold move. So they kind of broke down through some technical support there. We're a little concerned about that. It's come a long way. So yeah, I mean, it's interesting how that gold miner you're talking about didn't do much while gold was rallying. So I'll take the other side of that. We're out of gold and gold miners for the short term.
Interesting.
That's what makes a market.
For sure.
Yeah, you guys talked a lot about small cap. Are any specific sectors or verticals that you prefer?
We look at it in a very idiosyncratic way because we're really looking for what we would consider to be special situations, event driven, where something is going to happen. And so there are times when you'll see groups move together, right? The fiber players back in 2000, there was a time with the automotive suppliers. There was a time with the airlines. We're not seeing that quite yet. We're seeing more idiosyncratic, name specific issues. And many times it's because, among other things, the private equity sponsors have really levered these small companies. And a lot of what's been issued in the last decade is floating rate. So it's really putting pressure on the smaller companies because the regional banks aren't lending. Basel Endgame is coming. Liquidity has really tightened, particularly for what we would call the have-nots.
Right.
So, can I just jump in there on the stocks? I think some of our picks are pretty idiosyncratic also. We use a seasonal overlay, but we run a pretty robust fundamental screen for our stock selections, looking for acceleration of growth in revenue and earnings, good valuations, relative strength, humming below the market, and under followed by Wall Street. So we don't look for sectors. We let sort of a bottom-up approach tell us what sectors are hot. I mean, this is kind of where we found Supermicro, even Scott's Miracle Grow when they bought that hydroponic company, a bunch of other things. Last year we picked up some of the ancillary AI companies, nVent and MCore, some of involved in the infrastructure and heating and cool and energizing the data centers. There's a couple of those sectors that have come in. We got stopped out of our silver miner that we picked. There's an India bank. I know somebody mentioned the population growth. I think that was you, Tyson, or maybe it was a couple of people. So we have a little small India bank on there. We're seeing some, HVAC and transportation. It's a pretty good smattering. Admittedly, though, they're getting banged around here with this early December chop. So there's some interesting stocks there, but very, very idiosyncratic, as you were saying, Suzanne.
Suzanne, you brought up a point a couple of minutes ago about debt levels. Yeah, about rather credit strategies. But debt levels at a historic high, and there's a change in credit market dynamics going on. How do you think family offices should be thinking about their credit strategies or their fixed income strategies, particularly in light of the duration risk?
I think that's a really broad question to answer, particularly in terms of family offices, because everybody has different risk tolerances, parameters, et cetera. So I think
we're not providing advice.
Right. So as I said before, from the perspective of our family office, we don't do long only fixed income. And I remember years ago when I was a partner of the firm that we sold to Carlyle, we were a long short credit strategy. And my father added a bunch of money. And I'm like, Daddy, we're not tax efficient, right? Like this. And he said, let me ask you a question. With rates where they are, would you rather have your guys with more hours in their quiver managing my fixed income portfolio or some chimp at Morgan Stanley? And I said, you got a good point. So I think it depends on, again, what you're trying to accomplish. I always believe investing with managers that have more flexibility to go where as Gretzky would say, you want to go where the puck is going. You want to be where the puck is going. I do think you want to be very cautious in the direct lending space because I think there's going to be real problems coming out of that in a secondary where the underwriting standards were just not what one would have hoped. Listen, the Ares guys do a great job, et cetera, but there's other folks that I would say more marginal that I think are going to have real problems in their portfolio and more of a problem because they don't know how to fix them, right? They knew how to make these loans, but they don't really know how to work them out. So I do think that there will be advantages as new buyers of troubled private credit, but you want to be the buyer of the troubled paper, not investing with managers. And then I also think similarly in commercial real estate, lending, right? I think that there are a lot of these properties that are underwater. And if you've got new entrants coming into the market that understand that business with a fresh balance sheet to be able to work them out, I think there's going to be a lot of money made there.
And we work with a couple of real estate people, and right now, particularly, we're seeing a lot of turnover of older properties right now because the bubbles are coming due on these properties, and people that own them can't really afford them. They haven't been upgraded or in years, so they're doing a lot of value add, a lot of those types of things, and they're getting the prices where they can make it work. So, and of course, once we do all that, you can raise rents a little bit and make up for what you put into it.
Well, and in New York, I was just having this conversation with someone the other day too. In New York, you're seeing commercial properties being converted to residential,
right?
Where they can, because hard to do, right? Because a lot of these buildings are not structured in a way that lends the conversions, but where they are, people are seeing that as a place because we need more housing in New York.
Exactly, exactly. Manoj, I want to switch over to you, and I always feel when I go into this topic, I'm reminded of Wayne's World. Anybody see the movie, the first Wayne's World, right? And up there was gratuitous sex scene, right? Well, this is the gratuitous AI discussion. So as alternative data sources proliferate and AI capabilities advance, how will AI-powered trading strategies affect traditional quant managers' ability to generate sustainable alpha? And how do you intend, or how should managers be thinking about maintaining their edge?
That's a very good and complicated question.
I love
Yeah.
asking those types of questions.
So, in no particular order, here's a bunch of random thoughts about this topic. So first of all, we've done a couple of deep dives now into the AI space and how it could possibly improve our investing process. And one of the challenges that we've faced is that the emerging technologies, which are in the area of large language models, of course, the underlying foundation models are changing at such a rapid pace that it's very, very difficult to want to make an investment into using anything that's out there right now and anchoring on any existing technology for fear that it'll be obsolete in a month. Okay. And so that's one of the challenges. That's one of many challenges. Another challenge is that we already are in a space, the quant investing space, where, like many other markets, the biggest risk is concentration risk or winner-take-all effects. So most of the money in our space has been flowing into the so-called big platforms or other gigantic quant hedge funds, the Rentex and Two Sigmas of the world and so forth. And as these players get larger, their liquidity access get larger, and liquidations in the quant space can be quite brutal. Most investors don't even know about them when they occur. They sometimes don't even make it to the financial press. So the relevance of that to AI is that with AI, it's the way things are currently set up is very self-serving towards the large firms. Their foundation models are designed to be trained by tens of thousands of GPUs, which are extraordinarily expensive to maintain. There's no hedge fund in the world that can afford to compete with the likes of Google in terms of building their own LLM or their own transformer model. And so inevitably, you're going to end up using the foundation models that have been commercialized by the handful of large AI players. When you do that, again, you're just going to exacerbate the risk of crowding effects because you're going to end up doing the same stuff as everybody else.
What do you make of the garbage in, garbage out type of thought process with AI? I mean, there's issues with the data. I've dabbled with it with some of our studies and with some other things. It just seems like it's better if you give it a really good data and ask it a pointed question, but if you ask general things, you get pablum from the internet.
Yeah, I mean, my thought on garbage in, garbage out is don't put garbage in.
But is there a lot of garbage in there? Basically, still, is what I'm asking.
I mean, it really depends on what you're trying to do. So, for example, a very effective application for nonlinear models and complex models, like neural network models, is valuing options prices. Another very, anywhere where there's a lot of ex ante supposition of nonlinearity. So, for example, in the high frequency space, there's a nonlinearity introduced by the discreteness of the bid-ask spread. Okay, so whereas in traditional quant models, you can add alphas together with a weighted average, right? If I have a signal here that was developed by one team and a signal here that was developed by another team, I can take some linear combination of them, and the combined Sharpe ratio is guaranteed to be better than the Sharpe ratio of either signal on its own. That's not true in the high frequency space because of the nonlinearity imposed by the bid-ask spread. And so neural networks and things like that are ideal for modeling those kinds of effects, where the human brain is just not well equipped to figure out how these, multiple effects might combine, because the interaction between the effects is not linear. Okay, so there are definitely domain use cases. The main thing I would like to use AI for is that we live in a world where new technologies are emerging more and more frequently. And when they do emerge, it happens very quickly and it has a very disruptive impact on the equity panel. So for example, just recently we saw the advent of GLP-1 drugs, right? Like Ozempic and so forth. Wegovy, yeah. So, I mean, those have been out for a while, and the folks at CNBC and their morning programs were talking about it for a few weeks, and I knew that at some point, like something was going to happen, and sure enough, it did. Last year, I think it was early summer or late spring. Like all hell broke loose in the equity cross section, and people were just doing crazy things like buying airlines on the belief that passengers were going to weigh less and it'll save money on fuel costs, right? But like there's all kinds of crazy divergences, not just in the stocks of the companies that are manufacturing these drugs, but many levels far removed from where the action was centered around this stuff. We saw the same thing with AI itself, right? So once GPT-3 was released, I mean, it seems like ages ago, but it was really just like at the beginning of last year or the end of the year before. And when that happened, it had a seismic effect on the stock market. I mean, it sent NVIDIA through the roof. By the way, one thing I want to mention about NVIDIA is they're going to be at the center of everything, no matter what it is. Like they were at the center of crypto mining. They were at the center of gaming. They're at the center of AI. It's not an accident. It's because they have a very general purpose tool that does matrix multiplication very quickly. That's all it is. Okay, it doesn't do anything specific to AI. It doesn't do anything specific to gaming. But a lot of advanced quantitative models depend on multiplying matrices very quickly. And that's what their GPUs are ideal for. So most new technologies, where even quantum computing is going to be based on this kind of stuff. So I digress. The point I was trying to make was you have these recurring phenomena. They're going to recur with greater and greater frequency, where disruptive technologies are brought into the market, and they're going to have seismic impacts on very unexpected sets of stocks. And in our firm, we want to take bets on things that we have forecasted, but we want to neutralize our exposure to everything else. That's becoming increasingly difficult to do because in addition to the big 10 or big 40 risk factors that everybody knows about, like momentum and beta and things like that, there's all these new novel risk factors that are constantly cropping up that never existed before. And AI is a risk factor now. Okay. And so one of the things that we want to do with AI, and I think it's especially well suited for, especially with the computational linguistic capabilities of large language models, is to take news events and to basically rank all stocks by intensity and direction based on their relevance to certain news events.
Yep.
And by doing that, you can essentially create a risk factor that you can hedge the rest of your portfolio to if you don't have a view on it, right? So that's a very, very important application for us because, it's been smooth sailing for us outside of those isolated events where, some new technology creates a disruptive impact on the market. And, technology is exponential. So that's why I say this is going to happen over and over and over again with greater and greater frequency because of the increasing dependence of the economy on technology. So that's one application. But just going back to like the difficulty, I think the difficulty outweighs the benefit right now of using these kinds of models for the reason that I stipulated. Also, I think that same difficulty applies to investing in AI-based companies because they've done something very self-serving, which is to focus on models that are extraordinarily expensive to maintain, because that creates a massive barrier to entry. Okay. But the thing is,
What do you guys think of the cost of building out AI to
yeah, that's
companies?
the thing. They have purposefully invested in foundation models that are prohibitively expensive for the rest of the world to operate on their own, other than, the few people who are already in the business and who can subsidize the cost of these kinds of things through massive revenue streams having nothing to do with AI. Okay. Like if Google and Facebook were forced to subsidize their AI expenditures using just AI revenues, forget about it. They'd be toast. Same thing with OpenAI, right? They have a benefactor in Microsoft that they're basically burning equity capital in order to make these investments. Most firms in other businesses can't do this. And it's not an accident that these models are prohibitively expensive to run. It's by design. But the thing is that the brain doesn't work that way. Okay. All of these models are based on a technology, which in the end, it's called backpropagation. Okay. So basically, they gravitate towards an equilibrium state where errors in the network are minimized towards achieving some objective function. Okay. The brain doesn't do backpropagation. The brain does forward propagation. And forward propagation in theory would be much, much cheaper to implement in terms of training. And to me, it's just a matter of time before the transformer architecture and its descendants is obsolete. And when that happens, the firms that have invested, plowed tens of billions of dollars into R&D are going to be in trouble. So I think it presents a major risk factor in terms of investing in these kinds of companies for the future, because you have no idea which the dominant architectures are going to be in the future. Right now, it's all based on transformers. And I think that the big firms have a financial incentive to keep it that way as long as they can because of the barriers to entry involved. But at some point, a small firm or a small research lab or university department is going to come up
So I'm
with.
going to go back to Marty's question.
Yeah.
Is the quantum chip a threat to AI?
Not anytime soon.
Okay. All right.
The jury is out on whether it's even real.
Yeah. Where is the quantum chip? I've heard about it, but I don't see it
I mean,
anywhere.
quantum chips exist, and the fact that the best tech firms in the world are investing billions of dollars in this is a sign that they think it's real. Okay. But the thing is that quantum mechanics, poses all kinds of philosophical questions related to the nature of reality. And, like you have to ask yourself whether quantum superposition, which is the ability of particles to be in, many states simultaneously, is actually real, or whether it's a mathematical artifact. And it's just our philosophical attempt to impose meaning on this, on mathematical equations.
Sure.
And if it's the latter, then, quantum computing is basically an illusion. And I'm not saying that that's what I believe. But so far, quantum computers have not done anything useful. And the things that they have done can be done by standard computers faster. So we have yet to see, firm evidence that quantum computing has a future. And if and when we do see something, it's going to, the more interesting part of that to me is going to be the questions that answers about the nature of reality itself. That's the more fascinating part of it to me.
So I think that was an excellent overview of AI in a lot of detail for a lot of people. So it was very helpful in understanding how it's going to impact and the ways it's going to play and the ways that it won't impact. I think you made some great points in there, but I got to move it along for the other three panelists. And
Would you
Susanna, I
short
want to go back.
NVIDIA?
AI ultimately is a tool that can be used, right? But does it replace the human decision making. And particularly, I'm thinking about when you're diligencing and you're choosing a manager, which is the next panel, but we'll go on this a little bit early. What, how do you assess if a manager's been good or lucky, and is it possible to really determine the contribution to alpha? And Tyson, I'm hoping you'll jump in a little bit here too.
In terms of determining whether or not they've added alpha, right, you can look at those numbers after you've invested. The real challenge is, and I worked for a family office, and the guy had made his money being a good investor, and he taught me a lot about investing. And you sort of start, at least this is the way I think about it, of coming to the table from a place of no, because it's much more important to miss a bad manager than get a good one. And unlike any other business in the world, what the SEC makes you put on the front of your documents, past performance is not a good indicator of future results. In the investment business, that's true, right? If you're good at making widgets, unless your plant breaks down, you're going to make as good widgets yesterday as you do tomorrow. So that's not true in our business. And actually, the statistics are, you can go to Las Vegas, you bet 1% of your money on black, you win, now you're up 2%, now you bet 1% on black again, it comes up. You can statistically do that for 7 years before you get the string of reds that wipes you out, right? So how do you determine whether a manager is lucky or truly skilled? And I think there are a lot of metrics you can look at. How many decisions is that manager making? What is that manager's risk tolerance? I always get very nervous if I ask the question, well, like, what's your pain threshold? At what point do you say no mas? And there's not a solid answer to that. It hasn't been thought through. What is your feeling about use of leverage, right? For a strategy like yours that's market neutral, it's one thing. I was on a panel about yield at a different conference about a month ago, and it was me and a bunch of real estate guys, right? And they're talking about the yields on their books, and I'm like, yeah, but how leveraged you are? How levered are you? The yield on my book is net of leverage. So I really think about that. You want to think, and then I'll turn it over to other guys. But the other one big thing we think about building a portfolio of managers is making sure we're truly diversified. Because you can be invested with 20 different guys, but at the end of the day, they're correlated. And so really understanding what the underlying assets are, and that overall in your portfolio, you want a very diverse mix of what you're invested in. And that goes back to where our philosophy is. People are like, oh, why don't you do direct deals? Well, I mean, we have a nice sized family office, but I don't have the bandwidth, or would I be able to get the kind of diversification I'm getting investing with managers? And again, we do everything from venture to private equity, to real estate, to long short equity. So we're getting exposure to all those things, but I just don't have the bandwidth to, pick deal A.
May I make a brief point related to what Suzanne just said? What you said is absolutely true. It's the fundamental problem of investment management, is disentangling luck from skill, right? And it's especially hard when human beings are the ones making the decisions. This is one of the appealing things about quantitative strategies and automated strategies, is that human beings are not making the decisions. It's a repeatable, systematic process. And by and large, quantitative strategies.
But human beings are putting in the inputs to develop the quant strategies.
Absolutely.
And there's no question in quant. I mean, models break. Right?
Yes.
We saw it in August of 2007.
But I just want to hone in on something you said, which is the number of independent bets that you make in a unit of time has everything to do with the statistical significance of your track record. So if you're a long-term investor, then 3 years of track record means absolutely nothing, because how many independent bets do you really make over 3 years? But if you're investing for a 1 week horizon, trading thousands of stocks every week, think about the transactions costs you're racking up, right? If you can maintain a Sharpe ratio above 1.5 for a decade after paying that kind of transaction costs, the statistical likelihood of being able to do that by luck is 0.
I think one good way to judge a manager, and I think past performance, even though SEC says it's not indicative, what else you have to look at? I think one good way is how they perform in bear markets, how they do when the market's going against them, when there's volatility, and how they manage to either stick to their system or make it call an audible. And Suzanne, you made a point about staying away from bad managers. it reminds me of the Daniel Kahneman quote that losses loom larger than gains. And one of the things that we've looked
It's
at
just
for,
harder to come back from.
of course it is, and it's also psychologically more debilitating. That's how we're geared. There's something called the scientific method, disproving the null hypothesis. David Aronson, technical analyst out of Baruch and CMT fame, put a book out in 2008, Evidence-Based Technical Analysis. He put 6,000 plus black box systems through the scientific method, disproving the null hypothesis. All of them failed. None of them had predictive power. None of them, all of the results were the result of chance. We asked them to put our best 6 month switching strategy, November to April versus May to October through the same paces, unlike any of the other ones. That was the only black box system that had predictive power, and the results were not the result of chance. So I'm not a manager, but I know managers look at that system, and it's one that, has proved itself in bears and bulls.
And Tyson, we're looking for your insights here.
I have one question, and that's for Minaj, who I said was the smartest guy in the room, and I've yet to beat his proving.
Stop with that, please.
That's for sure.
And for the women out there, they want to know whether you're married or not. But that's not the real question. The real question is, would you short NVIDIA, and if so, when?
Oh, absolutely not. I would never short NVIDIA. So I guess that answers the question.
Never say never, but yeah.
I mean,
Not for the
me
foreseeable.
personally, but I'm sure that we have strategies that are short NVIDIA right now, even as I say that. It's impossible for me to know what's in our portfolio at any given time because we're running dozens of different strategies, all at different horizons. And I'm sure some of them may go short NVIDIA at some point. I know our core stat ARB strategy is long NVIDIA for some time now. It's not because I want it to be, it's just because its fundamentals back up that you should.
So you don't have problems.
Do you think it could be a $10 trillion company?
Market cap.
I don't know about 10 trillion.
4 trillion.
It can certainly be 6 trillion.
Thank you.
I don't know how much more time we have, but one thing that I've been thinking is we've been
got some
talking,
time, so
talking about all of these things that we haven't talked about is I actually think macro is going to be very attractive going forward. We all know that macro managers tend to be lumpy, and that's how you have to sort of know going into it that that's what it's going to be like. I mean, you should hear the conversations I have with my father's widow about why this is not a problem. But I do think that obviously increased volatility, dispersion between haves and have-nots, the issues we've got with currencies, interest rates, political instability is going to, it's just a great environment for macro managers who can trade around these things. So we've got pretty significant exposure, but that's a place I think is going to be really very interesting to be.
great,
Hey
great.
guys, I got to jump for another thing at 11. I really appreciate you having me. I wish I could stay longer. Great chat. Have me back again. I'd be happy to spend more time. Thanks very much.
I have about 10 more minutes. I have a couple of questions. Thanks, Jeff.
Fire away, Martin.
So, back in the day, there used to, people value guys would come to you and say, hey, there's an arbitrage because small caps aren't covered by Wall Street. That's my first question. Does arbitrage still exist because of lack of coverage? And my second question is, what are macro shocks that you anticipate could happen that would, influence the market negatively or positively? I mean, Tyson said Trump peace dividend and interest rates going lower. Are there others that are out there that could happen? So those are my two questions. The first one, does the value trade exist anymore?
Let's start with that one.
I think the value trade, I mean, you said an arbitrage, right? So I
It
think
used to be an arbitrage,
yeah,
right?
I don't think that really exists the same way anymore. I think it has to be much more bottoms up, fundamental analysis. Is this company a good company or a bad company? I mean, in our fund, we tend to, not always, it depends on the environment, but we like investing through the capital stack. Ultimately, in a restructuring or an event, we may end up with equity, but we like sort of the equity-like returns with the downside protection of fixed income. And we will often look at things at 70 cents on the dollar, buy a toe hold position, get underneath, do the work. Some period of time things go, Steve Lampy likes to say bonds don't stay at 70, right? They either get pulled to par or go down. And so sometimes we have a nice trade, the bond gets pulled to par. Sometimes we get under the covers and do the work and decide management's delusional, right? They're catering lunch every day and there's fresh flowers and they're losing money hand over fist. And so we'll trade out of it. And then some other percentage of the time, there's going to be a misstep. And now T row prices, small cap, high yield fund can't own it. These things are relatively illiquid. I mean, we're looking at cap stacks generally sub 500 million. So if you've got a cap, an issue in the cap stack, maybe you've got $100 million thing trading at 50 cents on the dollar. It's not that big, right? So the next trade might be 30. And we've already done the work to determine that that's the price at which we want to have a more meaningful position. And we wouldn't have, and if the street didn't know we were involved, it would be very hard to get access to the paper. But I don't think the arbitrage, the way you're thinking of it back in the old days, I don't really think that exists anymore.
You guys are coming to me forever saying that lack of coverage or there's.
Well, there's no
hidden
question that
gems.
there's, again, picking the right ones, the fact that there's not lack of coverage. And of course, one of the things that you do is you go and petition the street to get coverage. So there's no question that that exists, but I'm just saying a true arbitrage between, I'll short this to go long that because this is a small cap, but nobody's paying attention to it, but they're in a similar, I just don't think that works anymore. That's just me.
My take on this is, of course, quantitative. So if you're looking at value from the classical definition, yeah, I think that arbitrage disappeared a long time ago, which makes sense. Markets are efficient after all. But my firm runs over 50 different value models. And not only do they work, but they're our best models. So they work every year. They work almost every quarter. So the difference is that they're not classic definitions of value that were invented by accountants, 100 years ago. They're much more modern, engineering type definitions of valuation. So let me give you an example of one of the 50 models that works like gangbusters and always has, in my opinion, always will. Companies that are covered by the street or by independent research firms, you can observe earnings estimates on them, right? Out to different terms, right? Different fiscal year end dates, fiscal year 1, fiscal year 2, all the way up to fiscal year 5, usually for the most liquid stocks. So you can basically get a term structure of consensus earnings estimates, from all the way from 1 quarter ahead to 5 years ahead for most companies that are well covered. And not only can you get a consensus estimate of all the people who are covering this company, but you can get a dispersion around that. Okay. That dispersion is a indication of the uncertainty of the company achieving that level of earnings. Okay. So if you run a discounted cash flow model on that term structure, okay, in real time, on thousands of stocks simultaneously against the real-time price. Okay, in other words, you compare the real-time price of every company to what the discounted cash flow, properly discounted by not just the time value of money, but also by the uncertainty associated with each of the future cash flows. Okay, which is partly from the dispersion. You could also estimate it from the term structure of implied volatility. Okay, there's a lot of different ways to discount future cash flows. But if you do all that in real time, you will get a real-time alpha signal for every company. If you then neutralize that to 0, center that at 0 so that you're long half the stocks and short half the stocks, that basically always works. So that's just one out of around 50 different value models that we work. So if you do sophisticated things, valuation works, fundamentals work.
Tyson?
What's the question?
Thoughts?
I'm out of thoughts.
Marty, how about your second? Oh, Ross, you
Just have a question. If anybody on the panel is involved in ODTE options, or how does the existence of what has become known as ODTE options affect markets and what you do, if at all?
Are you talking about one day?
Yeah, 1 day expiration options. massive volume every day now.
Yeah, they're a pretty big deal, and they absolutely have had an impact on trading. I don't think that they have had any impact whatsoever on medium to long-term valuations, but they certainly impact intraday trending behavior and mean reversion behavior on stocks that have a high open interest in their one-day options. So we don't trade those, but we do absolutely use those as an input to trade cash equities, because they have a lot of, one of the main signals that we use to trade cash equities is the entire volatility surface. So there's only about 400 or 500 stocks where you can actually trade the options because they're liquid enough to trade. But there's around 1,500 stocks that have enough options for you to trade the underlying using the information that's contained in the options market. What do I mean by that? What I mean by that is that usually cash equities is the clearinghouse for information about stock, but not always. So sometimes when people have asymmetric information, like inside information, legal or otherwise, they may be attracted to the gamma offered by the options market in order to effectuate their bet, right? And one of the main ways that FINRA and SEC do surveillance is by actually looking in the options markets for anomalous activity. But anyway, you can do the same thing that FINRA and SEC do and try to detect that kind of activity, that's kind of asymmetric behavior, and translate that into a predictive signal for cash equities themselves. So we absolutely do that kind of thing. And the advent of one-day options was sort of a game changer for that.
Did you have a follow-up or?
No,
No, that was good.
I just, my last question was about macro shocks in the next couple of years that you could think of, outside of the peace dividend and credit.
The worst macro shocks are the ones that you don't see coming, like COVID and the response to COVID. Both were, I think, equal and opposite shocks to the system that had, far-ranging impact, and we're still experiencing today. And it's very hard to predict, by definition, what these unknowns are going to be, but they're guaranteed to occur.
Yeah, I mean, I think, and I agree with you, the ones that are the worst are generally ones that you can't think of or make up yet. But listen, I do think political instability and the fact that more people have nukes is a problem. And, what's going on in the Middle East, while it's far away and it seems like maybe it's not that big a deal, I think is a really big deal. And I think it's really going to roll over. And so I don't know, I don't have we're close to an answer to this, but I think terrorism will continue to become worse. And I think it's been there. We just weren't seeing it. It was capped. Now it's sort of like the Pandora's box has been opened and you're seeing pockets in all different places. And, this is not a good example, but the guy who shot the CEO of United Healthcare, right? Like, you wouldn't have ever thought that a 26-year-old Penn grad who graduated first in his class from an elite, high school would show up at 6:45 in the morning and just shoot some guy because he's mad at the healthcare system.
With math and computer science degrees, by the way.
Right. But it's like those things have become more acceptable, right? And I think certainly in the world I grew up in, it wouldn't even cross my mind. And so I think that there are, I do think terrorism and political shocks as a result of terrorism are going to persist. And it'll affect the market in all kinds of ways.
Well, some of that risk could be modeled. Climate risk can't. It's really hard to model everything. And it seems like that's a risk that people are kind of, no one's talking, so I can't talk about it, but it's perhaps real.
I mean, I think climate risk is real. I think it's a hard thing to model. You would know better than.
Well, the climate itself is extremely hard to model. I'm not sure how strongly I believe that the long-term prognostications of these models, and that we're going to turn into the atmosphere of Venus with runaway global warming. I don't know.
I think a lot of these events that have
To me, climate change is more of an opportunity than a risk in the near term, because the only way out of this, like, there's no doubt that human induced, climate change and global warming in particular is real. But the only way out of it is through technology. Like, developing countries aren't going to suddenly reduce their dependence on fossil fuels and voluntarily, undergo slower growth, just for the hell of it, right? That's not going to happen. And so, people in the developing world want refrigerators too. And so I think that technology is the only way out of it. And to me, there's just massive, massive alpha potential in the upcoming technologies we're going to see, both for carbon reduction and carbon sequestration and alternative energy, in particular, fusion energy, and things like that. I think that's the next big thing.
I totally agree with technology will make a huge amount of difference in climate change, and this is anecdotal, but it's also this next generation of children. My daughter came home in the 2nd or 3rd grade and said, "Mom, no more plastic in our house." And really, there's not none, but if there is, she's on it. And she's making sure that the plastic there is gets put in the recycling bin. And I didn't grow up that way. So I think that's helping too.
Steve?
You could address it. I think the world is moving away from military solutions to problems because it's not viable. It's not advantageous. It's not cost effective. Perfect example, if China were going to take Taiwan, it would have done it already. Perfect time to have done it was the last 4 years. 2, in terms of the situation with Ukraine, the solution might be a novel one, which would be Putin retires in 5 years.
If.
Wait, no, I'm advocating. I'm saying
Yeah.
that's part of the terms. He retires. Russia goes into the EU alongside of Ukraine. They both become EU members. Think about World War II. World War II, Germany tried to take over Europe. It did it after World War II.
Steve, I need you to cut to the question.
What's the question?
So the point I'm saying is we're moving more towards a world of where pragmatism, a logical solution, the problem versus military. What
But
do you
I think
about it?
I think that the thing that you're not factoring in is people and emotion. And I don't think Putin's going anywhere in 5 years unless somebody whacks him, which would be great. I don't think that Zelensky wants to be that conciliatory, right? This has really hurt the Ukrainian people. I know a lot more about the Middle East, so I'll take it from there. I don't know if you've heard of this guy, the son of Hamas. His father was one of the leaders of Hamas. The IDF turned him. He wrote a great book, by the way, called Son of Hamas. When he was 17 years old, he was arrested. The IDF turned him, and he ultimately brought his father down. But he said, I was on a relatively small Zoom call with him, that what should have happened after October 7th is Israel just should have bombed the whole place. And forget women and children, because otherwise it's never going to end. Because in the Middle East, for example, the Palestinians think there's a right of return. Forget the fact that the mosque is built up here and the temple's way down there, which tells you which came first, but they don't want to hear it. So I don't know about Russia and Ukraine. I know that I don't have hope for peace in the Middle East anytime soon, because you've got human emotion that won't allow them to come to any middle ground. That's what I think.
Yeah, it's hard for me to look at the Middle East and think that the world is not defaulting to military solutions as much as it used to.
We have to wrap this up. Marty's got the big hook and he's yanking me here.
Well, I
so-
think the reason why it may appear to be that way outside of the Middle East is just because of the nuclear deterrence. But that poses a risk in the future as well, because of the ability of states to proliferate, either unintentionally or intentionally. So political instability in places like Pakistan, which is a nuclear power, is a huge an ongoing risk factor. Recent developments in the Middle East are doing nothing but incentivizing Iran to pursue a nuclear weapon, which could, despite successful attempts by the Israelis to sabotage their nuclear program for the past 30 years, it's inevitable. It's that they're eventually going to get one. And so what happens then? So I don't know. I would like to agree with you on that, but I'm not sure that I do.
Thanks so much.
Fantastic. Thank you, Tyson, Suzanne, Jeffrey, and Manoj. Thank you very much.